Assalamualaikum everyone. Today, we will present the audit of inventory. There are 6 members in our group consists of AINNUR HAZIQAH, ALEEYA FAHERA, FARAH NADHIRAH, AKHMA FAZRIENA, Syahmi Omar and IRFAN AZAM.
I will discuss key points about audit of inventory. Unique relationship because inventory management has a close relationship with other transaction cycles. Any changes in inventory can significantly impact purchasing, production and sales. And with the sales of goods is the inventory process culminates in the sales of goods directly affecting company revenue. Auditing inventory is the most complex and time-consuming part. It involves challenging physical counts, inventory valuation, and ensuring data accuracy. Next, I will discuss the factors affecting the complexity of inventory audit. Inventory is usually a major item on the SOFP and the largest component of working capital. This makes it crucial to get right. Different locations of inventory make physical control and counting difficult. It's challenging to ensure accuracy when inventory is spread across multiple sites. The diversity of inventory types creates difficult for auditor. Different products may require different auditing approach and apparatus. Factors such as obsolescence needs to be considered. Auditor must assess whether inventory items are outdated or no longer useful. Different inventory valuation methods like FIFO, LIFO and weighted average add to the complexity. Each method has specific role and implication for financial reporting. Now, I want to discuss the related document for each process. Under process purchase order, related document with purchase requisition and purchase order. Receive raw material have receiving report and vendor invoice. For the store raw material have raw material per purchase inventory master file. Under process, the goods have raw material requisition and cost account record. Store finished good related document with finished good purchase inventory master file and cost account record. Last but not least, ship finished good have shipping document, finished good purchase inventory master file and cost account record. Now, I want to discuss the related document for each process. Under process purchase order, related document with purchase requisition and purchase order. Receive raw material have receiving report and vendor invoice. For the store raw material have raw material per purchase inventory master file. Under process, the goods have raw material requisition and cost account record. Store finished good related document with finished good purchase inventory master file and cost account record. Last but not least, ship finished good have shipping document, finished good per purchase inventory master file and cost account record. Overstatements in inventory are more likely to occur due to several methods a client might use including inaccurate inventory counts, which is incorrectly counting inventory can lead to overstatement, where more inventory is recorded than actually exists. Inaccurate inventory pricing. Use incorrect pricing for inventory can artificially inflate its value on the financial statement. Incorrect recognition of manufacturer rebates is misstating the recognition of rebate from manufacturer can also overstate inventory value. Failure to adjust to lower of cost or market, not adjusting inventory to the lower of cost or market value at the year end can result in overstatement, especially if market value have dropped. Incorrect valuation method. Applying incorrect methods or valuation like using FIFO when LIFO should be applied can distort inventory values. Failure to write off obsolete inventory. Not writing off obsolete inventory keeps unusable or unsellable item on the books, overstating inventory. In summary, overstatement, misstatement in inventory can occur 2. Inaccurate counts, pricing, rebate, recognition, valuation method, and failure to adjust for obsolescence or market condition.
Hi, continue with me. I'm HAZIQAH binti AZMI, which is the part of the audit of inventories. The overall objective in the audit of the inventories and warehousing cycle is to provide assurance that the financial statements fairly accounts for raw materials, work in process, finished goods, inventory, and the cost of the goods sold. The audit of the inventory and warehousing cycle can be divided into 5 activities within the cycle. Okay, the first one is acquire and record raw materials, labor, and overhead. The second one is internally transfer assets and costs. The third one is ship goods and record revenue and costs. The fourth one is physically observe inventory, and the last one is price and compile inventory. Next, diagram above summarizes the 5 parts of the audit of the inventory and warehousing cycle. Because of the interrelationship of the inventory and warehousing cycle with other cycles, some parts of the audit of the inventory are most efficiently tested with the audit test of the other cycles. As noted in diagram above, auditor tests the acquisitions and recording of raw materials, labor, and overhead as part of the audit of the acquisition and payment and payroll and personnel cycle. Also, they test the shipments of goods and recording of revenue and related costs in the audit of the sales and collection cycle. The physical observations of the inventory and the pricing and compilations of the inventory are audited using substantive analytical procedures and tests of details of balance. The last 2 boxes in the diagram above. In doing so, the auditor must consider business and inherent risk, the set performance maturity of inventory, and evaluate the results of the test of the controls and substantive tests of transactions for the transactions and activities in the first 3 boxes in the diagram. As part of the risk assessment processes, the auditors will consider whether any of the identified risks of materials misstatements consider a significant risk. The remainder of the chapter deals with the parts of the audit of inventory in diagram above that are tested as a part of the inventory warehousing cycle, including the use of analytical procedures, tests of the physical inventory, observations, and inventory pricing and compilations tests. Next, we continue to methodology for designing tests of details of balances of inventory, which is we need to identify client business risks affecting inventories and warehousing cycles. Next, we need to set tolerable misstatements and assess inherent risk of inventory and warehousing cycle. Therefore, assess control risk for several cycles. Next, design and perform tests of controls and substantive tests of transactions for several cycles. Besides, design and perform analytical procedures for inventory and warehousing cycles. In addition, design tests of details of inventory to satisfy balance-related audit objectives, which is the first one is audit procedures, second one is sample size, the third one is item to selecting timing, and the last one is timing. Okay, the last part I will present is management associations for the inventory business process. The auditor gathered evidence related to the inventory business process to evaluate management associations about the accounts in the process. These associations are, firstly, existence or occurrence for inventory and cost of goods sold transaction. The next one is completeness for inventory transactions. The next one is valuations and allocations for inventory ending balance. The next one is right and obligations to sales inventory. Next, occurrency for the cost of goods sold. The next one is cut off for cost of the goods sold in accordance with the standards. And the last one is classifications. Cost of goods sold and inventory is properly classified on the financial statement. Thank you.
Next, I would like to explain about the disclosure requirement for the inventory business process. There are 4 key assertions under this subtopic, which is occurrence and right and obligation, completeness, classification and understandability, and the last one is accuracy and valuation. For the first accession is occurrence and right and obligation. This accession means that disclosed event and transaction have actually taken place and pertain to the company. For example, to gather evidence for this accession, auditor will inspect document, which is the review shipping document, to verify the actual occurrence of recorded transaction. Second, examine legal documents and contract, which is the check ownership documents and purchase agreements to ensure that the inventory listed is truly owned by the company. This ensures that the inventory recorded on the company's book is real and owned by the company. Next, we have the completeness accession. This means that all disclosure that should have been made regarding inventory have been made. Auditors gathers evidence for the completeness by first, performing reconciliation, which is the reconcile inventory record with physical counts to ensure all inventory items are recorded. Number 2, conducting analytical procedure, which is they analyze inventory turnover ratio and compare them to industry standard to identify any unusual trends or gaps. And the last one is observing inventory counts, which is they conduct or observe physical inventory counts and compare the result with the inventory record. These steps ensure that no inventory items are omitted from the financial record. Moving on to classification and understandability, this accession ensures that financial information is appropriately presented and described and disclosures clearly expressed. To support this accession, auditors will review financial statement, which is the examine the classification of inventory in the balance sheet to ensure it is categorized correctly, such as raw materials, work in progress, or finished goods. This ensures that the inventory information is easily understandable and correctly classified. Finally, we have the accuracy and valuation accession. This means that financial information and all other information are disclosed fairly and at appropriate amount. Auditors gather evidence for this accession by first, testing costing method, which is they verify the costing method used, such as FIFO, LIFO, or weighted average to ensure they are applied consistently. Number 2, performing market valuation, which is they compare inventory cost with market price to ensure inventory is not overstated and make write-down if necessary. Number 3, reviewing estimation, and the last one is checking subsequent events. This ensures that the inventory is valued accurately and fairly. Next, I would like to discuss about physical observation of inventory. We have before observation, during observation, and after observation. First, let's talk about what happened before the physical observation of inventory. This stage is all about preparation and planning. Before the inventory count date, auditors should obtain and review the inventory count plan prepared by the company. This plan outlines the procedure and method that will be used during the inventory count. Reviewing this plan helps auditor understand the scope of the count, the location involved, and the personnel responsible. It also allows them to identify any potential risks or area that require special attention. Finally, let's discuss what happened after the physical observation. This stage is crucial for finalizing and verifying the inventory records. After the physical count, the data collected is transcribed onto inventory summary sheet. This involves consolidating all the individual counts into a comprehensive summary. Auditors compare the test count they recorded during the observation with the final inventory sheets. This step verifies that the quantity are consistent and that any discrepancies have been resolved. Auditors examine any confirmation obtained from the third party, such as supplier or warehouses. This confirmation helps verify the existence and ownership of the inventory. Finally, let's discuss what happened after the physical observation. This stage is crucial for finalizing and verifying the inventory records. After the physical count, the data collected is transcribed onto inventory summary sheet. This involves consolidating all the individual counts into a comprehensive summary. Auditors compare the test count they recorded during the observation with the final inventory sheets. This step verifies that the quantity are consistent and that any discrepancies have been resolved. Auditors examine any confirmation obtained from the third party such as supplier or warehouses. This confirmation help verify the existence and ownership of the inventory. Next, auditor prepare a memorandum documenting their observation, findings, and any issue identified during the inventory count. This memorandum include details of the procedure performed, test result, and any recommendation for adjustment. By performing this follow-up procedure, auditors ensure that the inventory is accurately recorded and fairly presented in the financial statement.
An auditor's physical examination of inventory is not required if inventory is housed in a public warehouse or overseen by outside custodians. In those situations, auditor verify inventory by confirmation with the custodian. However, if inventory stored with outside custodians represent a significant portion of current assets or total assets, the auditor should apply additional procedures for the auditing process. If inventory is material to the financial statements, auditing standards require the auditor to obtain sufficient appropriate evidence regarding the existence and condition of inventory. Auditors must verify that the physical count of perpetual record quantities are correctly priced and compared. Inventory price tests include all the tests of the client's unit price to determine whether they are correct. Inventory completion tests include testing the sheet summarization of the inventory counts, recalculating price times quantity, putting the inventory summary, and tracing the totals to the general ledger. There are 8 types of balance-related audit objectives and their test of details of balance for inventory pricing and compilation. The first objective is inventory in the inventory listing schedule agrees with the physical inventory counts, the extensions are correct and the total is correctly added and agrees with the general ledger. The procedure is first, auditor need to perform compilation tests such as see existence, completeness, accuracy objective. Second is trace the totals to the general ledger. Extend the quantity times the price on selected items. Next objective, inventory items in the inventory listing schedule is exist means that there is existence on the inventory listing schedule. The auditor can trace inventory listed in the schedule to inventory stocks and auditors recorded counts for existence and description. Next objective, existing inventory items are included in the inventory listing schedule, or we call it as completeness. The procedure is first, the auditor account for unused tag numbers shown in the auditor's documentation to make sure no tags have been added. Second, trace from the inventory tags to the inventory listing schedules and make sure inventory on tags included. The fourth objective is the inventory items in the inventory listing schedule are accurate, means there is accuracy in the listing. What auditor should do? He need to trace inventory listed in schedule to inventory tags and auditors recorded counts for quantity and description, and also perform price test inventory. Fifth, the inventory item in the inventory listing schedule are classified, which means there is a right classification to the inventory. The auditor must verify the classification into raw materials, work in process, and finished goods by comparing the descriptions on inventory tags and auditors recorded tags counts with the inventory listing schedule. Next, the inventory item in the inventory listing are stated at realizable value. Realizable value is the value of the inventory if it was sold after deducting the cost of selling. The auditor need to perform tests of lower of cost of market, selling price, and obsolescence. The client has rights to inventory items in the inventory listing schedule. An auditor can trace inventory tags identified as non-owned during the physical observation to the inventory listing schedule to make sure these have not been included. Lastly, the objective is the inventory and related accounts in the inventory and warehousing cycle are properly presented and disclosed in the financial statement. Auditor need to examine financial statements for proper presentation and disclosure, including separate disclosure of raw materials, work in process, and finished goods.
Next, for internal control testing, the transaction audited in the inventory process include first, determine the correct amount of inventory, number 2, price it according to accounting standard, and number 3, Value the year-end inventory balance. Since auditor only consider the ending balance of inventory in inventory process, so internal control relevant to transaction are not part of this process. Substantive test for inventory process. Auditors perform substantive audit procedure to gather evidence to evaluate whether the financial statements are prepared according to the applicable financial reporting framework. And this is include first, analytical procedure, number 2, inspection of record, document or tangible asset, number 3 is observation, number 4 is inquiry, number 5 is confirmation, number 6 is recalculation, and number 7 is reperformance. Based on my previous slide, how will we know that the financial statements are prepared according to the applicable financial reporting framework? There is two main types of analytical procedure that are used to gather evidence and to evaluate this. Number 1, the auditors compare the financial statement for the current year with previous year and then calculate the amount and percentage of change. And number 2, the auditors calculate financial ratios for the current year financial statement and compare them with ratios for the previous year financial statements. And also, the auditors can compare the client financial statements, numbers or ratio with the industry data if available, and could use non-financial data as well. In the inventory business process, auditors could perform the following analytical procedure. Number 1, compare inventory balances. You can compare for the current year with previous year by category such as raw material, work in process, and finished good. Number 2, compute gross margin. You can compute for the current year and the previous year. Number 3, compute inventory turnover. You can compute inventory turnover by compare the numbers for current year with previous year. You need to investigate if there is any unexpected changes in numbers or ratio or any unexpected differences. Analytical procedure and the possible misstatement. As we know, analytical procedure, we will compare the numbers from current year with previous year. So what we will compare is first, gross margin percentage. The possible misstatement that can affect inventory and cost of goods sold is over or understatement of inventory and cost of goods sold. Next, inventory turnover. The possible misstatement for inventory turnover is obsolete inventory. Obsolete inventory is inventory that no longer produced. Number 3, unit cost of inventory. And for possible misstatement is over or understatement the unit cost. Number 4, extended inventory value. The possible misstatement is misstatement in compilation, unit costs, or extensions. Lastly, manufacturing cost. The possible misstatement is misstatement of unit cost of inventory, especially direct labor and manufacturing overhead. You need to avoid all these misstatements as all of these can affect inventory and cost of goods sold.
Now, we move to the substantive test of balance. Substantive tests of balance for the inventory accounts in the statements of financial positions are essential to ensure that the inventory is accurately recorded and fairly stated. These tests help auditors gather sufficient and appropriate evidence to support their opinions on the financial statement. Here are the key substantive tests of balance for the inventory business process, focusing on the observation, inspections, and reperformance. Substantive tests of balance for inventory involve through procedures to verify the accuracy and validity of inventory balance reported in the financial statement. Here are the examples of these tests and their respective process. Firstly, auditor typically start by selecting a sample of inventory items listed at the year end. They then perform physical test count on this selected item. This process involves physically counting and verifying the presence of this item in the warehouse or storage facility. By doing so, auditor aims to confirm the accuracy of inventory record and ensure that the item physically exists as claimed. This test primarily addresses management assertion regarding the existence and valuations of inventory. Audit procedure utilized here include direct observations of physical inventory and inspections of supporting documentation such as inventory record and count sheet. Secondly, auditor may choose another sample of inventory item from the final inventory listing. In this case, the focus shifts to performing price tests on the selected item. Price tests aim to validate the inventory item are correctly valued as per the accounting standard and pricing policy in the place at the year end. Auditor achieve this by inspecting purchase invoice, price list, or other relevant documentation that substantiate the recorded value of inventory item. Additionally, they might perform calculations to ensure that the valuations is accurately reflected in the financial statement. This test directly addresses the management assertions of valuations and employs audit procedures such as inspections of documents and the performance of calculations. The auditor might also review the client level of cost or market, which is NRV, adjustment by sampling inventory item and performing price tests to ensure these adjustments are accurate. This process tests the management assertions by valuations using inspections and re-performance method. Additionally, this auditor assesses the reasonableness of this adjustment by sampling inventory item again and verifying recorded costs to ensure they are correct and comply with the accounting principle. This step also focuses on the valuation assertion, ensuring the financial information is reliable and accurate. Now we move to the Evaluating Internal Control for February 2022 exam paper. Example from questions. Upon the receiving of the job order, the clerk of the billing department will then create sales invoice based on the respective job order. The possible internal control weaknesses is inadequate inventory record. The impact of the weaknesses to the company is inaccurate inventory record due to the reliance on potentially erroneous job order for billing. Suggestion to rectify the weaknesses is implement an inventory management system and perform regular reconciliations between physical inventory counts and system records to identify and resolve discrepancy. Next, example from questions is there are no other additional supporting documents that are demanded upon submission. Possible internal control weaknesses is poor documentation and authorizations procedure. Impact of the weaknesses to the company is unauthorized inventory transactions and adjustment, increasing the likelihood of error and inconsistent. Suggestions to rectify the weakness is establish comprehensive documentation, requirement for all inventory transactions, and implement control to ensure that only designated personnel can approve significant inventory transaction. The third example from question is there was no clear procedure pertaining to the change of status of account receivable to bad debt account status among the client. Possible internal control weaknesses is infrequent physical inventory count. Impact of the weaknesses to the company is a discrepancy between recorded and actual inventory level may go unnotified, and there is difficulty in detecting theft, damage, or loss of inventory. Suggestion to rectify the weaknesses is to conduct regular physical inventory count and cycle counts for high value or high turnover items. Investigate and resolve any discrepancy identified during physical counts to maintain accurate inventory record. The fourth example from question is the normal credit term given as in the invoice is 30 days. However, there are a special case whereby the credit term are only 15 days. Possible internal control weaknesses is ineffective monitoring of inventory turnover. Impact of the weaknesses to the company is overstocking of slow-moving item and stock out of the fast-moving item, leading to the increased holding costs and decreased customer satisfaction. Suggestions to rectify the weakness is regular analyze inventory turnover rates to identify slow-moving and fast-moving items. Implement demand forecasting technique to better predict inventory need. The last example from question is upon arrival of the goods and cargoes, the document will be handed over to the storage and logistic department clerk for further shipment process. Possible internal control weakness is inadequate handling of return and damages goods. Impact of the weaknesses to the company is mismanagement of return and damages goods, leading to inventory inaccuracy and financial losses. Suggestions to rectify the weaknesses is develop and implement standardized procedure for handling return and damages goods, including proper documentation and authorization, and use the inventory management system to accurately track return and adjustment.